Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 340. And today I'm going to show you data of the market before and after every budget and see if we can draw any insights from the past 20 years of data before and after the budget that we have. But first, a regular reminder to all Weekend Investing subscribers that we have introduced the first ever uh, discount program by any small case manager that rewards you as you continue with the strategy for a longer period. So there's a reward at 1 year, at 2 years, at 3 years, and so on and so forth. These rewards are automatically applied to your account. So when you go to resubscribe and click on apply offer, it should be available to you. In case not, you can always feed in as per the format. You can let us know. We'll let you know the exact format. Also, you can use these discounts to subscribe to any other weekend investing strategy. That is valid for about 30 days from your renewal date. So this is a constant reminder to all weekend investing subscribers. Now, this range that Nifty has been stuck in 17,800 to 18,200, we again came very close to the bottom range here. This is, I think, a morning chart. My team should have put a closing chart here, but nevertheless, it did come to about 17,850 odd and closed a bit higher than that. So we have been stuck in this range. Now the question is that how to get out of this range. So usually what happens is whenever there's a range movement, whenever the market is stuck within a range, some climactic event happens which causes a major trend in either direction. Now it's very difficult to say what direction will it be. We have the union budget on 1st of February. We also have the Fed meet announcement on 1st February night for us. We also have the Chinese New Year opening on 1st February. So many global trends will start from that day. How we will shape up is to be seen. Of course, in today's market, there was a third party report that has alleged that the Adani Group stocks are uh, falsely inflated and there is corporate governance issues. There have been, I think, several attempts in the past also, and SEBI did do some deep dive into this subject, but now this another 175-page report has come, and this has come from a company which is a professional short fund. So they do this for a living. They find companies that are overvalued and they will come out with a report that these is overvalued because of this reason, and hence we are shorting it. So the report is very motivated. It is no different from anybody who was caught in some front running scandal where they bought stocks, then they came onto the TV and they recommended those stocks and that stock went up. So this is very similar to that, though it is more in dressed up in a more official manner. The timing of the report is also circumspect because it comes just as the FP of the Adani Group, Adani Enterprise. Now, I'm not taking any judgment call whether they are right or wrong, whether Adani Group has done any falsification or not. Let the market decide. Let the regulator decide. We will go as per the prices. The prices start to fall off, and if we hold some Adani stocks in some portfolios, we'll get out of them. But we will not take a judgment call based on one third party report having a impact on this. But yes, that has sort of uh, you know rocked the mood in the market today. All Adani stocks, including Gujarat Ambuja and NDTV, all the associated stocks also, everything took a beating. Also, PSU banks took a lot of beating today. Uh, they were down 3.6%. So the largest hit has come from 3.6% in the PSU banks. Excuse me. It seems that people are doing a second order think that if Adani Group is going down, then PSU banks have a lot of leverage and exposure to Adani groups, and hence. But I think it was just possibly a knee-jerk reaction, and I'm hoping that in the next one session or two sessions we will get over this report. Real estate stocks down 1.8%, pharma 1.2%, commodities, public sector enterprise, energy, infra, bank nifty, private banks, everything was down except autos, which remained flat, FMCGs remained flat, and metal stocks, which is hoping for a upswing once the Chinese markets open. So a quite a red day. Everything was falling. So was all weekend investing strategies. In the broader indices, you saw Nifty Next 50 take a huge hit because it has the most Adani stocks at minus 2.5%. CNX 200, CNX 500 down 1.5% each, Nifty 1.25%, and small caps down the least at minus 0.9%. Weekend investing strategies also lost ground along with the broader indices, and all strategies were down between 0.5% and NNF10 taking the most beating at 3.73%. So, bad day for all strategies, no doubt about it. Here's today's heat map. There is virtually no grain except mild FMCG gain in levers. Maruti up 1%, Tata Steel, GSW Steel, Hindalco all managing some small gains, but the biggest hits came in the banking space. SBI down 4.5, HDFC Bank 2.75%, IndusInd Bank 4.6%, ICICI Bank 1.7%, HCL Tech Wipro more than 1% each, Adani Enterprise 1.5%. In fact, the surprise was that Adani Enterprise only fell 1.5%. Cipla 2.5% down, Adani Ports down 6.3%, Ultra Semco, Tech Mahindra, Reliance Industries all down more than 1%. So, pretty bleak day. And this is the data uh, which shows you in the first column the movement of the market 1 month before the budget, leading to the budget, 1 week before the budget in the second column, 1 week later, post the budget, 1 month later, 3 months later, and 6 months later. And the data is of last 23 years, 24 years actually. What we can see and observe very, if you see in from uh, broad perspective, is that in the earlier years in 99 to 2005 6, there were big run-ups before the budget and big sell-offs after the budget. Somewhat the number of larger bars in that time period look more, even up till 2008-9, I would say. So this 10-year decade had more volatility pre and post budget. If you look at this last 10 years, you'll see that that has come off quite a bit. Of course, 2014 may be an aberration year, it being a first budget of the new government, uh, and the Modi rally in that year. So I think I would discount that, and I will discount the COVID fall in this 2020. If you leave these two data points, the pre and post, the week before and week after, or the month before and month after, don't look so dramatic actually. 3-4% movement in the run up to the budget, plus or minus, and 3-4% post the event is not a very decisive move. The decisive moves are like 9% here, 20% over 3 months, things of that kind, or within a week, moving 5% here. Very mild moves in the last 5 or 10 years. So this somewhat is an indication that over the period of this last decade or so, we have started to see the budget as a sort of a non-event actually, because the plans of this government are more longer term in nature, and they are not really disrupting the status quo in any budget, at least not so far. We have not seen any major disruption of any kind that was unexpected in any budget. In fact, the biggest sop that the government gave for corporate taxes came outside the budget, I think in September 2017, if I'm not mistaken. So, I'm not expecting this budget to be outside the current trend. We have seen that the market is not really having any pre-budget narrative or a rally before this. We may get some last 1 or 2 days, a few percentage here or there, but the market is pretty solidly inclined in that range. And unless the budget really rocks something, I think we will continue to follow more global cues than local ones. And of course, the Fed meet and uh, metals and commodities from China, those things probably will matter a lot more post the budget. Still have three trading sessions before the budget. So after today's a bit of a fall, I'm hoping that the next three sessions will probably stabilize within this range, and then let's see what the budget may bring out. I'm hoping and I'm praying that there is no adverse taxation on capital gains, etc. If they want to simplify things, then of course simplification is always possible without disrupting things. So that's that for the budget. Another insight that I wanted to share with you was on our neighbors. So this is the chart where we have the US dollar to Pakistani rupee, the dark blue line, up 470% in the last 25 years. US dollar INR is this orange line, up 125%. US dollar Sri Lankan rupee, this aqua line, 518% up. US dollar Bangladeshi taka, 140% up, this mustard line. And US dollar Nepal rupee, also in line with Indian rupee very, very closely because it is a bit tied to the Indian rupee. What is seen here is that we are increasingly surrounded by bankrupt nations. So, two of our neighbors have gone bankrupt, and Bangladesh and Nepal are not also in any very healthy situation. So, if you see the analogy, if you are living in a glass house, nice house, and you have four neighbors around you who are bankrupt, how long will you remain safe? Of course, we are a different might and different size, but nevertheless, these disturbances can impact us in some ways. It may be beneficial also that maybe Bangladeshi business may start to move towards India, the exports from there. uh, but the point that I want to make out more here is the way their currency has behaved. So while till 2014 or even till 2018, the deviation of the Pakistani rupee and Sri Lankan rupee was not very far off from the other three. But then their currency took off, and against the US dollar, it crashed like anything. What the point here is that India was also bankrupt in 1991 when Manmohan Singh had to open up, the doors for foreign investment to come in. We had to pledge our gold to save the day, and we were in a situation not very far from where these people are now. There is nobody who can say that that day can never come again. Although I will, uh, uh, never wish that that day comes again. But when you have a situation where governments change every 5 years, and there is all the possibility of some joker type government coming into power, then anything can happen at any time, and you have to, as an investor, be prepared that you have to face that eventuality. Now just imagine that you were a wealthy person in Pakistan, and you are living in your bungalow and you have your businesses and life is hunky dory. But what is happening around you? Your entire assets are in a currency that is dropping, you know, like a torpedo, and your equity markets. This chart is actually the MSCI Pakistan ETF. We're representing the Pakistani business in dollar terms. Is plummeting like nobody's business. So you maybe have been sitting pretty in 2016, putting up your industry, looking good, and then 7 years later, you are sitting at a minus 64% position versus 2016 in dollar terms. I'm not even talking in Pakistani rupee terms. What if you had a hedge and you had a 50% allocation to gold, and gold in dollar terms is up 64% in the same time period? You would have maintained your purchasing power and your wealth regardless of how the economy of Pakistan behaved, or how the Pakistani rupee behaved versus the dollar. Isn't that really powerful as a hedge, as an insurance, as a last resort? That if your country and your currency and your government goes to the dogs, you are still probably safe. Why would you not do this to your portfolio? You will not do this to your portfolio if you are not aware, or at least if you don't rule out that in the next 50 years something like this can ever happen to India. It happened just 25, 30 years back. So it will not happen in the next 30 years is no guarantee, although I don't wish for it. But the prudent thing, why do you take life insurance? Why do you protect your car with comprehensive insurance? Why do you take health insurance? Because of the eventuality that you are not hoping will happen. This is the same thing. This is the insurance for your portfolio, for the eventuality that you think will never happen, and yet it gives you returns. So I think I've beaten this message a lot of times into your head. You probably are irritated by my frequent uh, you know uh, reference to putting gold in your portfolio, and we also have two portfolios which use the gold hedge. So either you can do an asset allocation outside the equity strategies, or you can use the same to combine the two. So MI Evergreen is one such strategy with CNX 200 stocks, where you can combine gold and the best stocks of CNX 200, and that has done really well. It has done more than 20% in the past performance. Or you can go with the free access NG 50/50 momentum strategy. Just add Nifty and gold ETFs together, and it has been performing in double digits. I mean, what else is required from a low risk strategy? So you can use any of these. You can go to weekendinvesting.smallcase.com and use any of these strategies. This is the end of this daily bite. My request, like every time to you, is to share this video with at least one person who you think can make use of this, one new friend or your family relative who you think can make use of this information. And I'll be obliged if you do that. So thank you so much, and I will see you in another video. Bye.